Good morning, Richard Calhoun, Creekside Realty, 40 years in the real estate business here in Silicon Valley. We're here today to talk about the last week's real estate market and the impact of COVID and the overall real estate market. Pretty incredible. I believe it's week 38. Basic information. The green is what I call my base URL. That takes you to the YouTube archives. If you add the year 2021, you get to these live sessions Saturday morning at 9 o'clock. You're welcome to join. If you add the year, month, day code, you get to the specific archive. And if you add in the word handout and the year date code, you get the handout, which is posted as of about 5 minutes before the hour. This is looking at the available inventory in the blue down here. And you can see that when you look at the macro data, which is San Mateo County, Santa Clara County, single family homes and condos and townhouses, we're only at about 70% of the expected inventory. If you look at the number of new listings coming on the market, the gray line, that's essentially right on top of the yellow line above and below. So we've had the right number of new listings coming on the marketplace. So how do you explain the shortage of inventory? You explain the shortage of inventory by the red line, the demand line, which is indicating that it's running about 20% above the yellow line, which is the 5-year median, 2015 through 19. So we've had far more demand this year than you would expect. And 15 through 19 were all 5 good years. And so we're selling 20% more homes, and that ends up with less inventory. Eventually, if that continues, the reservoir will eventually go dry. And you can see the reservoir, which is the total available listings. And my available listings do not include those that are in escrow seeking backup offers. You can see it started the year at about 145, 150% of the normal expected inventory. It dropped down to 100%, then it dropped down to 80%, and now we're dropping down to 70%. And we'll get down to the breakup in a minute, and you'll see that it's not uniform. And here we are. If you look at single family homes in Santa Clara County, we only have 50% of the 5-year expected level of inventory. That's defined as the 5-year median inventory for week number 38. If you go to San Mateo County single family homes, they have 82%. So they're quite a bit closer to normal. If you look at Santa Clara condos and townhouses, they're at 106.7%. So they're above normal. And if you look at your bay cities in San Mateo County, everything on the bay side of the mountain range, basically, they're at 195, almost double the amount of inventory that you would expect to have. Reason the number is so low is Santa Clara County single family is the single biggest marketplace. So it's not at 50% as that indicates. I'm estimating it somewhere around 70%. That's the weighted average of these 4 components. So you can see it's going to make a huge difference if you're looking for a home in Santa Clara County single family, or if you're looking for a condo townhouse in the Bay Cities, the market conditions you're going to be under. Then if you look at DUI, you can compare it from this week to last week in the different areas, and 18.9 is just absolutely on fire. It's the hottest of the 4 major micro market areas. You can see Santa Clara County condos and townhouses and San Mateo County single family homes are essentially the same at 28.8. And then finally, the Bay City condos is at 36. Now, just to put that in perspective, 36 may sound high compared to 18, but anything below 40, I consider to be a red hot seller's marketplace. So all 4 are in a red hot seller's marketplace. Santa Clara County single family homes is just more in a red hot marketplace. If you look at overbidding, that doesn't reflect as much as I would have expected it to do. They all reflect that you're a strong seller's marketplace. You're seeing frequency of overbidding for single family homes around 80%, for condos and townhouses around 70%, and the magnitude of overbidding is around 108% for single family homes and around 103, 104% for the condos and townhouses. I'm just surprised that there isn't more of a differential. I would have expected Santa Clara County single family homes to be outstripping San Mateo County single family homes. And in fact, they're not. They're essentially identical. This now is looking at the DUI. DUI is days of unsold inventory. It's the supply demand ratio. It's the single biggest indicator of what the market's going to be doing in the future. The blue line down here is current marketplace. The yellow is where you'd expect the 5-year median to happen. So you can see that the real estate market slows down typically the year progresses, and it happens much earlier than a lot of people think. And the reason for that is DUI, the speed of the marketplace, is fastest earlier in the year. The peak volume of inventory occurs later, just like the 5 weeks before Memorial Day. So a lot of people sense that extra volume as to be extra pace, and it's two different things. It's how fast you're going versus how many people are going. But you can see it normally slows down, and this year it basically hasn't slowed down at all. Now, a spike like this might alarm people that aren't familiar with it, but real estate has a strong cycle. It's got a weekly cycle, a monthly cycle, an annual cycle. It's also got a cycle associated with holidays. And basically, this is Labor Day. Labor Day was on September the 6th this year. And if you look back in 15 through 19, you're going to see the bulk of those years were earlier. So basically, it looked like the holiday came a week later this year than in my 5-year median. And that's why this big spike up. But you can see as soon as you got through the holidays, it came right back down. So that's just one of the things you have to watch out for. This actually caught me by a little bit of a surprise. This is the overbidding for each week. And we had been improving, then we were going down, we improved, and then we went back down. But if you look now this week, the purple's almost back in the center of the pack. So it's hard to see it, but I'll sort of try to trace it down with my red dot. So you start at the top, you're near the top of all the lines. Now you're sort of towards the bottom third. Now you're sort of back up in the middle, down here, maybe the bottom third through here. And then down here, it gets to the point where you can't even see it. So basically, last week was this yellow gold line here, and sort of the orange line, then the gray line. So you can see the last 2 weeks, there's been dramatic improvement. Keep in mind, sale price to list price ratio requires sale price. So these are closings. So there are closings that happened in the last week, but those offers were negotiated 6-7 weeks ago. So it's a lagging indicator, but it's still an indicator, and it shows sort of the pressure that buyers feel they're under to get a house. The dotted line up here is the best month we've ever had and the worst month. So you can see we're doing pretty well overall. This is appreciation. This is not looking at year over year appreciation. And the reason I don't do that is if you're only looking at the sale price on any given week, even if you use 5 weeks of data, there's a lot of fluctuation. So what I decided to do is use the calendar year median price for each one of the micro market areas, and then what percentage of appreciation have we seen since then, and the yellow highlights are the highest for the year. So you can see there was a lot back here right at the beginning part of July, but now you can see the expensive areas are coming to their own finally and having the highest, but so is the cheapest area in East San Jose, Central San Jose, and South San Jose. And all these appreciation numbers for single family homes in Santa Clara County are pretty high, basically 15 to 25%. That's pretty significant. Now we're coming down to San Mateo County, where we saw they had a little bit more inventory, and the appreciation for the most part is a little bit less. The expensive areas have had essentially zero appreciation. This is sort of a real surprise. Redwood City had a 25%, 24% appreciation earlier this year, and now it's back down to zero. So that's a major ride, and I have no idea why there's that kind of volatility. It's nothing I would expect because Redwood City is a fairly large sample size, and to see that kind of decrease is sort of a little shocking, but it's probably almost a statistical fluctuation because you can see the 20% appreciation was pretty solid for a long time, but now this low number's been there. A potential possibility is if a builder came on with some low-end houses, that would bring down the median price without impacting property values. If you look at the Bay cities, 20%, 12% in Foster cities in the North San Mateo County. So that's a quick recap. Again, the URLs are here for anyone that needs them. The handout is posted. I have customized statistics if anyone's interested in that, and I'll pause for a second to see if anyone's got a question for me. Not hearing anybody, I will proceed. Now what we're doing is we're looking at the breakdown of the different components. We're looking at the macro area, and you can see we've gone down a little bit in inventory. We went from 1875 down to 1813, but if you look at the different areas, there's quite a bit of difference. Single family homes in San Mateo County went down in Santa Clara County, went up in condos and townhouses in San Mateo County, but went down. So basically 3 of the 4 micro markets went down, like the overall micro market went down, but those San Mateo County condos actually went up by 10 units, which is a 5% increase. And you can see it did the calculation there for me. Now what we're looking at is offers accepted. We're looking at a 1 week and a 5 week number. And the reason you do that is just to get a gut feel of what's happening. Is the market accelerating or slowing down? And you can see that calculated down here on the bottom, the DUI. So week number 1 for San Mateo County single family homes is 23.4. 5-week DUI is 30. So what that's saying is we've sold a lot more houses in San Mateo County in the past week than we've done for the average of the past 5 weeks. Santa Clara County is almost dead even, with the last week actually being a little bit slower than the 5-week median. In San Mateo County condos and townhouses, it's a lot slower in the last week. And in Santa Clara County, it's essentially even, maybe slightly slower. This now is looking at the days on sold inventory in those 3 major micro market areas. You can see long-term what's happening. You can see the impact of COVID, where we basically shut down and people weren't making offers, or not as many offers. So the DUI obviously went way up because the demand went down. Then we started to recover. We recovered gradual. This was the initial what's happening in the marketplace. Once people realized the market never went away, then there was gradual improvement. This is the holiday slowdown that you'll see every single year for the most part. And then this year has been basically flat and very, very strong marketplace. You can see the condos and townhouses in Santa Clara County. The yellow line has been going up slightly, but again, they're all solidly in the red. Remember, the red area is anything under 40 is I consider to be a seller's marketplace. This is my heat map. This shows the Santa Clara County and Mateo County geographically, and it shows you the days on sold inventory, and it's color coded. So the redder the color, the hotter the marketplace. We have one area that's in white, the expensive areas in San Mateo County, Atherton, Menlo Park, Portola Valley, and Woodside, with 60 days of unsold inventory. So that's in the balanced marketplace. And I'll note, generally, the market spends very little time in a balanced marketplace. It's typically either in a seller's marketplace or in a buyer's marketplace. About the only time we're in a neutral marketplace is when it's transitioning. And I'll also throw out that there are a few exceptions to my 40 to 80 rule, and they tend to be South County, the expensive areas, and Saratoga, Los Gatos. And they just tend to be a little bit slower marketplace overall. So even the 60 in Menlo Park, Atherton really does not concern me. This is looking at the number of active listings without an offer. So those pending continue to show I don't count. The purple line is helping to distinguish between last year and this year. To the right is 2020. To the left is the current 2021 year. In 2020, you have to subtract 1 from the week. So you'll notice that there's week 53. That's really week 52. And I do that to get this horizontal separation from the data, just to make it a little more evident. Otherwise, the computer is going to draw a line between this point and that point. By skipping a week, it doesn't draw the line. So you can see that the inventory this year is below 1,750. And last year, essentially at this time, we were at 2,300. So you can see there's a fairly significant difference in inventory. Last year, it was basically normal. And this year, we're quite a bit below normal, because the yellow line is where you'd expect it to be. This is looking at the number of new listings. And this is, pretty, you can't really expect better match than this. So the sellers coming on the marketplace are exactly what we'd expect them to do. So this concept that Prop 19 was going to get all these sellers to come on the market and solve our inventory problem, it isn't working in Santa Clara and San Mateo counties. It may be working somewhere else in the state, but we're not getting any more sellers on the marketplace than we would expect to be getting on. This is now looking at the number of new offers. Here you can see that the blue line does follow the yellow line for the most part, but the blue line is significantly above the yellow line. So that's basically saying there's been more demand. Basically, from sometime maybe around July of last year, maybe even a little earlier than that forward, the demand has been outstripping what you'd expect it to be. And if you go back and look, the 5 years I'm using, 15 through 19, were 5 good years. buyers. So we're having just a huge volume increase with a little bit of a surprise on why. Because if these were buyers that were trading up, they would be selling their existing home most likely. So then you would have a flood of inventory. So we have extra buyers that are coming from renters or coming from out of state or whatever and are buying in Silicon Valley, which is something I was not expecting. And I don't think anyone was expecting during COVID. I could have expected higher turnover, but as I was saying, if you were having higher turnover, you'd be getting a higher number of new listings coming on the marketplace, and that's not happening. This is the frequency of overbidding. You can see that we're up here in the realm of around 75% of the sellers are getting more than their asking price. Yes, we're down from our 82, 80%. We were at 80% for a good part of the summer. And that's just, 8 out of 10 sellers getting more than their asking price. I mean, if you went anywhere else in the world and told people that, I think they would think you're crazy. This is the overbidding in the different micro market areas. I do have a little data issue with this that I was able to sort of correct, mostly up at this high end. I don't think my data is incorrect on this particular slide after I corrected it, but there's something that's bothering me on these steps should all be happening on the same day. And I have a stair step going through my data. I'm not able to sit down. I am going to continue to look for that. I do believe the data's accurate, but it's one of the questionable ones. The raw number today is accurate. Over time, I'm not sure. The overbidding, you can see the different micro market areas, the same concept. The color, the red of the color, the more sellers are getting over their asking price. The white color is basically somewhere between 33 and 55%, and you can see it's sitting at 45%. Foster City is coming in strong, still at 100%. Every one of the sellers in there is getting more than their asking price. And I have checked that, and that is, in fact, good. I didn't go all the way back to the raw data, and I probably will do that because it's hard for me to believe that we're going on about 5 weeks now with 100%. And yes, it's a small area. It's probably only about 12 homes, but for all 12 to be getting over their asking price is just a data that when you're suspicious like I am, is hard to believe. This is the magnitude of overbidding. You can see we came down and now we've done a sharp U-turn. So, I don't know if 5 weeks ago time frame this sort of corresponds to people getting ready for Labor Day, but there is a more fluctuation in the overbidding than I ever expected. And again, the heat map, seeing a little bit more shades of color, with Morgan Hill being one of the less amounts of overbidding. Obviously, Menlo Park, Atherton being the lowest. Here's a table. I thought this was pretty good because it gives you an overall view of the different micro market areas. I will be adding in the condos and townhouses. I will probably be using Friday's data for condos and townhouses because I just don't have enough time to process it and get everything done by 9 o'clock. I was posted the handout at 8:55. So I will probably start using Thursday's data down here, at least for the color coding, because that takes a fair amount of time. But basically, you can pick whatever your area is. You can find out what their days of unsold inventory is. You can come and look at the frequency of overbidding, the magnitude of overbidding, and equally important is the price range. Or you can start at the price range. What price range are you in? And then find out what kind of market conditions you're likely to look at. It is interesting on how close these three areas are. So we're looking at Redwood City, San Mateo Coast, and the moderate areas in Santa Clara County are all about, their medians are all about 1.65 million. And so that turns out to be the median for the valley. But to have three areas all right there is pretty close together. And you can see their lowest ends are pretty close together and their upper ends are a little different, because in the coast, you can get up to $3 million, where in Santa Clara County, you can only get up to $2.2 million. And that's because on the coast, you could have a property right on the coast, a property with a great view, that kind of stuff that would bump up the value. So there's more price range fluctuations on the coast. But it's just interesting looking at that. We saw this graph, but I just bring it back up because we're going to be going to this one. So now you can sort of see the purple line here. Here you're looking at 12 weeks of data. This is the most current. The dotted lines are the oldest weeks. So you can see the three, and there's the fourth one right through here. So the fourth week is essentially right where the purple line is. Then you had 3 great weeks in the end of July. Then you had 4 3 weeks recent, the most recent 3 weeks down here at the bottom, and now you've improved. So basically you're back to where you were in the middle of August, and these are closings again. So the offers were negotiated about 6 weeks earlier than that. This is the heat map for the sale price of the different areas. The bluer the color means it's below the median price for the area. The three white areas, the moderate price, the coastlines, and Redwood City are basically all white in color because they're essentially the median. The expensive areas are the deep red. The cheap areas are the deep blue. This is a little confusing. I've only done this for a couple weeks, so I'll go into this a little bit. This is giving you 5 weeks of data. It ended last night, Friday night at 11:59, and it goes back for 35 days. I'm comparing it not to the same period because I don't have that data going back for 20 years, but I'm comparing it to my next benchmark going forward, which is the October 6th data, which is what I label September 1st. So this September 1st data would be data that starts on September 1st and goes into the future for 35 days, but I'm doing it 36 days in the future from September 1st. So I have all that data, but it gives you an idea of where we stack up to the data that will be coming out shortly. And basically what you can see is the average days on the marketplace are pretty low. They're pretty reasonable. 16 days, you have 16 back here in 2013. You only had 35 days on the market versus 47. So if you were looking at that, you might say the market's slower or the same. But what it's really saying is you have some people that are overpriced that are staying on the market for a long period of time. One of the things that's interesting here is the median ask price of what's on the marketplace. It's actually lower than what it was a year ago. And now what you might be thinking, wow, prices are coming down. Well, you have to be a little bit careful because if you look a year ago, the typical home was 2,125 or 24 square feet. This year, it's only 2,008 square feet. So you're 116 square feet lower. So you're selling smaller homes, and those smaller homes may be in less desirable areas and things of that nature. So you're not comparing apples and apples typically when you have that kind of differential. So it's something you wouldn't expect. I wasn't expecting it, but it doesn't mean prices are dropping. Inventory at 682. If you look back, the only year that was close is 2017, and we're now below 2017. I think it was just last week I was talking about how we were above, but because I was expecting inventory to go down because it typically goes down, I thought we could catch it. Well, we caught it before, and we still have another 10 days for it to even drop lower. So we now have the lowest inventory of any time in the last 20 years that's on this chart. And I have data going back to 98 so I could look, but I'm not aware as I speak, not based on data, I'm not aware of a year with lower inventory. Now, if you go down to DUI, 18.9 days. And if you look back, you can't find a lower. And so this is a record low DUI. That's a record fast speed of the marketplace for this time of the year. We've never been going faster. Now, homes that are selling, and this is almost a contradiction, but it isn't. Homes that are selling faster than they ever have. So back up here, we were talking about in 2013, we are on the market for a longer period of time. So you would think that would mean the homes that are selling are on the market for a longer period of time. No. Now we were one day longer than 2020 on the median, but not on the average. Your averages dropped. So I would actually say this is a faster paced marketplace, and the DUI is sort of the tiebreaker and the more important one at 18.9 days. So that really comes out on the faster side. Price you can see now of what's selling is actually higher by $120,000. Sales per day is up, but now if you come back to 2012 and earlier, you'll see all those numbers were higher except for coming out of the 2007 meltdown. Basically, one of the long-term observations I've made is the number of transactions are dropping every single year in Santa Clara County and San Mateo County. It doesn't make a lot of sense because we are building new houses. There's more people. There's more units to be selling. So you would expect inventory and transactions to be increasing, but they're actually decreasing, which is saying people are staying in their homes for longer and longer periods of time, which makes sense as homes becomes more expensive and it's harder to move in and out of them. Then if we move down to closings, we finally get the overbid price, and you can see at 107.9%. That's a record high. We've never had that kind of magnitude of overbidding at this time of the year before. And the frequency of overbidding at almost 80% is basically at a record high. Pricing is also at a record high. We're at 1.6. Now, when I'm saying a record high, it's for this time of the year because we were at 1.640 or maybe even 1.670 earlier this year. So prices have come down a little bit, but not dramatically. And they typically come down going into the holidays. And the high end is also basically at a record high. So you're having record high pricing. And now this chart is very similar. The format is identical, but this is where I'm comparing from the first of the month for 35 days. And since I don't have 35 days for the month of September, I'm looking at August. So this is historical data. So I'm not going to go in there, and I just leave it in there for completeness. And that wraps it up. So I'll see if anyone's got any questions before wrapping it up and wishing everybody a good week. Anyone have a question for me?
Richard? Yeah, I have a questions on the table that before you started. I think it's around page 5 or 6.
Let me see if I can.
Before you had an introduction.
Okay.
This one. I'm looking at it, the very expensive, the San Mateo expensive one. So I think you said that the medium for the 2020 is 3,950,000.
Correct.
And so I just wonder, can you actually make a table like this for compare the 2018 year? Because I noticed, especially like a Middleton area, I think that the price back in 2018, I'm talking about lower end, it did not really increase since 1918.
What I can do, let me see if I have that available. There should be a chart, a table that's made up for me in my macros. And
yeah, well, their selling is slow. Also, their price didn't really increase that much for 3 years. That's what I don't know whether you'd be able to see it from your
well,
chart.
I'm going to get there.
Oh, okay. Well, take your time.
So you're just comparing. Let me see how far back this goes. That's to 2020. So here I go back to 2018.
Okay,
So
yeah, 2018.
Let me.
And
You're not seeing this, are you?
No, I didn't see it. I still see the 2020.
Yeah, let me get it set up, and then I'll do a stop share and a new share. Okay, so that's about the best I can do quickly. So you're seeing this graph?
Yes, yeah, I see this graph.
So basically, the light green is the 10 percentile pricing starting in 2018. So this is January 18, January 19, January 20, January 21, and all the way up to today's date. So this would be September 24th. The light medium green is the median price, and the dark green is the 90 percentile price. So basically, yeah, if I was to look at this, there's fluctuation, but there's really no price appreciation is what it would appear to be. And I should be able to, if we wanted to look at exact numbers.
So that means, well, I'm talking about a lower end, the 10%.
The 10 percentile? Okay.
Yeah.
Well, let's get over. Let's just look at the table because sometimes, and I'll do a new share here in a second. So stop share, green share. So are you seeing my table now of data?
Yeah, yes, I see the table, but with question marks.
With question marks?
Well, yes.
Oh, but okay.
Oh, here I get. Yeah, I see
the
some
bold,
numbers.
sort of in the very center.
Yeah. Okay. Yeah. Yes, I see.
So these are the prices. So right now we're on the 25th. So you're at $2.4 million. So you can see that up here you were at 2.6 million, but it bounces around a lot. So 2.4. Let's just go back. Okay.
This is this year, current year, right? Okay.
It was, and now we're back to 20.
Okay.
So
2022.
So now you're back to 2020. So we're still at 2.4 fairly often. 2.4, 2.5, 2.2. Okay. Well, here, so July 30th of 19, you were basically at 2.4.
Right. Yes. Oh.
And I'm here you're at 2.6 and 2.4, 2.34, 2.36.
Yeah, see, look at the 2018.
2018 was, in the heat of the
Okay,
marketplace was, because now you're talking about April, so you're basically at the same number.
yeah, yeah, the 17 is pretty high. I think it
And
was
so
the 18.
I only have data
Right.
going back until January 6th of 2018.
So I think it seems that the price range is about 2.5, 2.4.
Yeah,
So it
well,
hasn't really changed that much. I
it
mean,
has not,
yeah, it hasn't
correct.
really increased.
It has not really increased, but you also have to look at, what is that home? But, flip over, let's just go over to the median price for a second and I'll bold that so it stands out.
Yeah,
And these 39.75 don't exist. So this is the data that I
right.
got
Yeah,
calculated this morning.
yeah,
So basically you're at 4 million.
right.
So, you got up to 4.4 million, 4.5 million, and now you're still at 4 million, still at 4 million, still at 4 million. I am not seeing any 4 million. So the
Yeah,
middle,
it is. Yeah,
oh, yeah, we are. Here we are, August
yeah.
of 19. Yep, there's some 4 millions.
Hmm.
There's some
Yeah,
4
that's
millions
right.
in
Yeah.
December of 18.
Hmm.
July of 18 with some 4 millions. So yeah, the median of the market hasn't gone up any either.
Yeah.
So yeah,
Okay. Well, that's what I just noticed, but a lot of homes already, rebuilt. I mean, yeah, they're selling in 4 millions, but that I'm just talking about the old homes. Yeah.
well, these would
Okay.
be old homes, new. This is what's selling on the MLS. So this would be everything that's selling on the MLS. So if someone goes in and tears down a house and builds a spec house and lists it on the MLS, it would count in that.
Right. Yeah. So these homes are selling in 400. Yeah, 4 million.
4 million.
Yes. Okay. Well then, yeah. So that's what I just look at it. The 2018's price is about the same as now.
Yep.
Yeah,
And
it's the area. Okay. Basically it's the area, the middle part. That's what I'm looking at.
well, yeah, Menlo Park, it's clearly the area that's the price, but it's interesting that these people are, to me, having been in this industry for 40 years, real estate's a great investment. But
Right.
I also try to, look for homogeneity in the structure of the neighborhood and, for clients, because if you're buying a house that backs up to a freeway or anything like that, and negative, when the market slows down, it's going to be very hard to sell your house. I haven't really
Mhm.
paid attention. Maybe the top end of the marketplace, they're not so worried about investments. And, it is hard to believe that we've gone through, 4 good years and there's been no price appreciation. That's sort of something I wasn't aware of. It's
Yeah.
sort of
Yeah.
counterproductive, because what that's saying is it's saying that the typical home, the median price home for Santa Clara County or even for San Mateo County, is catching up to the more expensive neighborhoods. So the differential isn't so high. And
Right.
there is
Yeah.
fluctuation like that, because I still remember the time when the Mercury News called me up, and it was in about 2005 or six. They had a theory, and they were going to write an article that showed that homes in good school districts appreciated more than homes in bad school districts.
Mhm.
And I said, I don't think school districts have anything to do with appreciation of real estate, because good schools tend to stay good. And so they appreciate based on good schools, and bad schools tend to stay bad schools. So they're appreciating on bad schools.
Mm.
And I got the data, and all of a sudden, the exact opposite of what the Mercury wanted to report was what the data supported, which was the lowest performing schools had the highest rate of appreciation. So now
Mm.
I was perplexed and had to explain, why was this possible? And then it was not only possible, but it's what you should have expected. And it had nothing to do with schools. It had everything to
Mhm.
do with poor areas. The
Mhm.
liar loans were very common in 2005, 4, and 3. And so the homes appreciated dramatically because the people that had bad credit, didn't have any income, could
Right.
just tell the lenders anything they wanted to and could get the
Yeah.
loan. So the barriers to get into real estate went away. So the demand went up. So their prices appreciated
Yeah,
and
I
they
see.
got over the market. So they were unrealistically high, and it had
Right.
nothing to do with schools. And so the Mercury never ran the article.
No, why?
you know,
Well, that's it. That's true. Actually, that is a very good explanation.
anything else, or is that it for this
Oh,
week?
no, that's all. Yeah, that's it. Well,
Well,
thank you
thanks
so
for the
much.
question. It was an interesting
Look
one.
at
I like questions. 'Cause I actually learned something on this time. It's something I
Okay.
wasn't aware of. So thank you.
Yeah. Oh, thank you, Richard.
Take
Bye.
care.
Yeah,
Bye-bye.
you too.